NewEdge Wealth, the CIO, Cameron Dawson. Cameron, I forgot which podcast it was, but listen, you kind of wrote about this though. June has been a dud so far. Listen, we kind of peaked here, which it doesn't feel because the quarter was so magnificent. And you're saying the AI enthusiasm is getting fair. You're just a little bit concerned. And also you mentioned this 50-day moving average, which we've been tickling here.
Yeah.
So you're a little bit nervous right now.
Well, not necessarily. I mean, we don't always want to be pure rainbows and sunshine.
Why not?
Because we have to be.
Don't you have a song for that?
Well, we certainly do. She's a rainbow, right? How about that one? Yeah, look, we are in an uptrend. We are in a bull market. And it's really important that we start by appreciating that. But that doesn't mean that we should throw all caution to the wind and completely ignore risk.
All right, so let's talk about those risks. Yeah. You've got a long list of them. Risk and things that keep you up at night, okay? I'm like, golly. I mean, you look pretty good. No bags under the eyes, but obviously this is a pretty big list. Pockets of excess. Talk about that.
So this is where we're seeing things like flows into leveraged ETFs being very extreme. You also see it globally. Look at the leverage that's being added in South Korea, in Taiwan.
They've got a mania out of this world that I don't think we even had during the dot-com era.
No, and the reality is that we know how manias end. They can go a lot further and longer than you think, but they tend to unwind with a lot of volatility. So we have to continue to monitor this. We see it in the U.S. as well. Look at margin loan balances that are at all-time highs.
But as a percentage of the market, though, the chart is going this way. Even though the loans are going this way, as a percentage of the market, it doesn't seem too scary to me. I'm going to get to a lot of stuff here with you. Excess supply. After 20 years of taking money stocks out of the market, maybe not the worst thing, but this is what I want to ask you about because not a lot of people talk about spreads.
Yeah, it's interesting. We always think about credit spreads as the canary in the coal mine because the credit market is not as sensitive to the emotions that we often see in the equity market. So when you see credit start to get worse, but equity is still rallying, oftentimes that is a divergence we have to pay attention to. So if you look at high yield spreads, they look okay. But if you look at the worst of high yield spreads, this is triple C's, the junkiest of the junk. You've actually seen 200 basis points of widening this year to the highest level of spread since we've had the Liberation Day. So this is not to say sell everything or run for the hills.
But this is a serious canary in the coal mine we got to pay attention to. Of course, I talk about private equity for over a year now, and we talked about the folks over in the Cosby. Talk to us about earnings, right? Because earnings estimates are pretty high. Listen, we came in huge, right, for the first quarter, and we're anticipating the second quarter to be pretty strong as well.
Yeah, I think there's three important things to take from this Goldman chart. The first one is that the bar for 2Q earnings is higher. Remember, we got that 27% earnings growth in 1Q. We came into the quarter expecting just 9. So 22 is a little bit of a higher bar as we go into the second quarter. The other one is that the median stock earnings growth really hasn't changed. That's those diamonds, those gray diamonds across the line, is that the median stock is still growing high single digits. The last one is that you have this one-time gain from Amazon and Google that boosted the first quarter earnings because of the gain on Anthropic. So the question is, do we get that again in 2Q because you've seen Anthropic valuation go up a lot?
Some also say, hey, if you take out NVIDIA and maybe Chevron and a couple names that are expected to have massive earnings, this gets you back to here, right? So maybe that's not so unreasonable.
It's not unreasonable, and it's not anything to necessarily make you bearish. It's just to say that earnings remain very strong, supportive of the market, but certainly not as strong as you might see on the headline number.
Mags, you're a little bit worried about they're breaking down?
Yeah, the technicals have not been great on the Mag 7. And what's fascinating is that it's all been driven by valuation derating, meaning that you've seen about 10 multiple turns come out of the Mag 7. Earnings are still strong.
But usually that would make you want to start to lick your chops a little bit, no?
Well, exactly. And we've been having this conversation. Look at NVIDIA that's trading at its lowest valuation in the last 5 years in an uptrend at support. There's some things that start to look more interesting. We think the reality is a lot of these names are oversold in the short term, but they're dealing with these structural changes because now they're not cash generative.
All right. So having said all of that, Mrs. Lincoln, you still say the uptrend is holding, right? So net, we stay the course for now, or?
We stay the course and we continue to look over our shoulder for any deterioration in earnings. This market is strong because of earnings. If you see earnings decelerate, that's when we think we could see more volatility in prices.
Great stuff. Thank you so much. All righty. All right, folks.